the cash flow statement. So until now, we've read about the profit and loss statement. And today, first we need to understand why is a cash flow statement required? What are the benefits of a cash flow statement? And then we'll look at how a simple cash flow statement is constructed. So let's take a simple case, very simple case, where someone is running a juice stall or a tea stall or something. Okay, lemonade stall. So the person sells, let's say, 100 cups of lemonade per day. Cost per cup is rupees 10. So the person has earned rupees 1000 actually. Okay. Now the selling price, this is selling price. Selling price is so much, and then this is then the revenue. Now let's say the cost per cup, the amount it costs the person is basically rupees 5, just for an example. So then the total cost is rupees 5 into 100, which is rupees 500. Right. So the person's profit is actually 5000 minus 500, which is rupees 500. So in an ideal scenario where all the people who come to his lemonade stall, let's say they pay on the same day and they pay at the same time as soon as they buy the cup, we will have a situation where this guy realizes an actual profit of 500 and the cash he receives also is rupees 500. But let's take the scenario where out of these 100 cups, let's say 90 cups paid today, paid as soon as they ordered. For 10 people, they have requested credit. They have said, hey, we'll pay it to you in 1 week. Okay. The selling price remains the same. So the actual cash he has received from the customer will be 90 into 10, rupees 900. Okay. Accounts receivable. So he has to receive from 10 people, rupees 10 per cup. This is rupees 100. Okay. So now let's take the third case scenario. Another scenario where let's say only 10 people paid. Okay. 90 people requested credit. So then the actual cash received from the customer is rupees 100. Accounts receivable is rupees 900. Now in all three scenarios, let's say all 100. In this case, we are saying all customers paid on time. Okay. In all three scenarios, technically the person has sold 100 cups selling rupees 10, cost per cup is rupees 5, and therefore the total cost of this person is 500, the profit is rupees 500, whether it is in this scenario, or in this scenario. But if we consider the three different scenarios, here he has actually received 1000 rupees in cash. Right. So for the next day, he will have, let's say he has to again purchase these raw materials and other things. He still has that 500. He can pay that 500, purchase the raw materials, and then continue to run the business. Now in this case, he has received 900. He receives approximately 500 per day for our argument's sake. He still has 900. He still pays 500 and he still has 400 for his as his profit. He actually has that cash. But in the third case scenario, this person has only received rupees 100. Now, assuming that he needs another 500 tomorrow to run the business, the person doesn't have the 500. So because the person has not received the cash, the person is not able to buy raw materials for the next day and the person is not able to run the business. So in this case, even though the profit is 500, technically when they say the profit and loss is 500, the profit is 500. But in this case, even though the profit is 500, which is the same as this case, but in this case, the business has to shut down, right? Because he doesn't have the money to buy. He doesn't have the money to basically buy the raw materials over here, and he doesn't have the money to run the business. So that is why it is not only important to know about the profit, but it is also important to know about what is the cash situation of each company. We have to know whether the company can run its business, whether the company will shut down, whether there are any issues in cash, and so on. Right. And the actual cash flow is very, very important for any business to run successfully. We need to be very confident that they'll steadily keep getting cash. And in businesses where, let's say, there are companies which may give loans and then people just take the loans and then they are unable to repay, etc. The business actually comes under financial distress. Or in any company where the sale is made, but then you have a large proportion of the customers who are not able to pay back or who make a lot of delay in paying back, etc. The company basically comes under financial stress. So if you look at the profit and loss statement of such an organization, it will show a very good profit. It will show a very, very good profit, and we'll think, oh, the business is running great. Right. If we look at the profit and loss of all three of these stalls, lemonade stall, let's say stall A, B, and C. If we only look at the profit and loss, then we'll say all three are equally good or equally bad. But if we start looking at the cash flow statement, then we'll know that, okay, this one is actually really good. And this one is actually a terrible business. We should never have anything to do with this business if we get a chance to purchase this business. So from that perspective, the cash flow statement becomes very important. Okay. So cash flow statement is a financial document that shows how much money moves in and out of the business during a specific period, right? So this we have understood why it is not the same. Then we look at the structure of the cash flow statement. So the cash flow statement has three things. So we are looking at the end-to-end cash. What is the amount of cash that is going in and what is the amount of cash that is going out? So the first thing is the operations, the cash from operating activities. And here we have only considered the cash from operating activities. Here there are some raw materials. Using that raw materials, there is a finished product, right? The finished product is sold at rupees 10 and so on, and therefore he's making a profit of rupees 500. But then there'll also be investments involved. The person has to set up a stand. The person has to set up things like glasses and equipment for manufacturing the store, the juice, and so on. So there are these investing activities, and then there are financial activities. The person may not have the initial amount to start this business, so the person may take a loan, and then the person has to repay that loan. So all those aspects are covered in the financial activity. So cash flow is in three things. One is it is the day-to-day operations from operating activities. Then there are investments, right? Buying and selling assets. And then the third thing is financial activities. That is from raising or repaying loans, etc. Okay. So now there are two ways of preparing the cash flow statement. One is the direct way and one is the indirect way. So the direct way, we'll just look at the direct way. Direct way says, okay, what is the amount of cash we have actually received? What is the amount of cash that is gone? And what is the amount of cash that is left into a business? So this is basically a direct way. The indirect way basically starts from profit, right? And then it adds a lot of other cash items, and then it basically makes changes using some of the balance sheet items, etc. It makes changes using, so it generally takes the net profit and then starts adding back and subtracting relevant amounts to get an idea of what the cash flow is, right? So it calculates cash from the operations by directly listing all the cash inflows and outflows. Instead of starting with the net profit, it shows the actual cash received and the cash paid, right? So then we have cash flow from operating, investing and financing. This is there for all three. And then it provides a very direct and clear picture. And it's very easy for stakeholders to understand, okay, this much of money has come in, this much of money has gone out. So let's take a simple cash flow statement, and this is calculated from a direct method, right? And this can be over any period. This can be over a quarter, this can be over a year, this can be over a month. We can even prepare this over a day, but typically we'll see it that as part of the financial statements, this is done every quarter and every year when we look at the actual annual statements and the quarterly statements of companies. Okay. So here we have this cash flow from operating activities. So operating activities is day-to-day activities to run the business. So it has received cash from customers and they have made cash. Cash has been paid to suppliers for the raw materials and all that they have bought. And then cash has been paid for this utility employees for employee salaries, right? Then let's say there is cash for rent and utilities. So rent and whatever other stuff that they have bought. And then there are taxes and then there are taxes. Let's just keep it simple. Okay. Now, from this we find and then there is interest paid. So from this we find that, okay, there is this 10 lakh and then all these amounts are subtracted and then we have 1.5 lakh. Now, cash received from sale of machinery. This is investing activity. So investing activity maybe let's say that they have bought some new equipment and then there is some old equipment and they have sold that old equipment for scrap. So then this equipment purchase has cost 1.5 lakh. The old equipment has been sold for 50,000 and cash from investing activity is basically it is a negative of 1 lakh. Right. Now there is financing activity. Let's say they have taken a new loan, which is approximately 3 lakh. They have done a loan repayment, which is like 1 lakh. And then let's say the business has also paid some dividend. Okay. So then this is approximately 1.5 lakh. And then we'll see, okay. So this is 1.5 plus 1.5, which is basically 3. 3 minus 1 is 2. So then the net increase in cash is basically 2 lakh. Let's say this company at the start of the period, it had an opening cash balance of 1 lakh. So now it has a closing cash balance of approximately 3 lakh. So this 1 plus 2 is basically 3. And this is typically how a very simple cash flow statement in the direct way is made. Right. So in the direct way, the actual cash inflows and the outflows are very clearly listed, whereas indirect method will start with net profit and adjust for non-cash items. We'll look at this. This shows the exact sources of cash from where we have got. Is it from the customer? Is it to supplier? Is it to salary and all? But here net income for cash is there are some adjustments that are made, right? And we'll look at what are these adjustments and so on. This is easier to understand for stakeholders. And this is generally used by analysts to understand. Okay. So indirect method will start with a net profit or loss from the income statement, and then it will start adjusting for non-cash items like depreciation. Depreciation is cash that we haven't actually lost. Right, it's not money that has gone. It's a theoretical amount we take, saying that my equipment, I initially paid a certain huge amount for my equipment, and then over a period of time, I say that this equipment, maybe let's say over 5 years, that equipment will slowly degrade, and then 5 years later, I will have to purchase a new equipment. So I will take a theoretical cash amount, which is 1/5 of the cost. And then there are non-operating activities. We'll look at all this changes in working capital. We'll look at all this as we look at the actual indirect method. So this is the indirect method. Okay. we look at the net profit. We always start from net profit. So this is the net profit that has come from the income statement, the P&L statement, the profit and loss statement. And then in this net profit, there is something called depreciation, which we have seen. We are adding the depreciation because the money hasn't actually been gone. Then let's say that there is a provision for bad debt. So what is provision for bad debt? We'll just go down and see it. So it's an estimate of the amount of money the company expects not to collect from customers, right? If a company doesn't, for example, if a customer doesn't pay, the company reduces its profit by setting aside an amount for this potential loss. But creating a provision is just recording an expense to anticipate the loss. There is no money that is physically leaving the company. The actual cash shortfall happens later if and when the customer fails to pay. So sometimes companies make a provision for bad debt. They actually have the cash, but they're saying, hey, we have not received it. And then they have made this provision of 5,000. But maybe let's say after they've made this provision, if the customer actually pays, then the cash has been received by them. If the customer doesn't pay, then the cash has not been received. And that may happen, let's say 1 month or 2 months later when they officially find out that the customer is not able to pay or able to pay. So on the date, so let's say on date X, they have made a provision for bad debts, right? And then on date X plus say 3 months, they find out that the customer is able to pay or not able to pay. So on that date X plus 3 months, that's when the actual impact is felt on the cash flow. But over here, this is a theoretical amount that is taken, saying that I expect this money to be lost, but this money is not actually lost yet. Therefore, from that perspective, this is just as an example, we will add these items and we will say this is the operating cash flow. And then we look at the working capital. So first is increase in amounts receivable. So what is amounts receivable? We'll just go here and see it. Yeah. So if accounts receivable increases, it means the company has sold goods or services on credit and hasn't yet received the cash, right? This ties up cash. So let's say I sell goods. So let's say last year my accounts receivable is 0. I don't have to receive anything, right? But at the end of this quarter, my accounts receivable is 10,000. So the customers, which we were looking at that lemonade example, there was a lot of accounts receivable that the customers had not paid. So in that case, there is no cash received. And because there is no cash received, we have to subtract it. So in this case, where we said last quarter, let's say there is 0. And then this quarter, let's say there is a 10,000 in accounts receivable. So what does that mean? That this 10,000 amount is yet to be received. I don't have the cash for that. So we have to subtract that amount from the cash flow statement. Similarly, we have account payable. Account payable is the exact opposite, right? I have availed a service, but I have not yet paid for it. So then when the account payable, when I am yet to pay for it, then I have the cash with me. So the account payable is basically behaving a little bit opposite. So here, if there is an increase, it is negative. Here, if there is an increase, it is positive. Then we have inventory. So inventory is something that if the inventory increases, the company has purchased more goods or raw materials, which uses up cash, right? When there is a decrease in inventory, the company has sold goods or raw materials that is freeing up cash. So in this way, so when there is a decrease in inventory, the cash has been freed up. So this amount is basically gone up. And then we do this addition. There is minus 10,000 plus 8,000, which is the minus 2,000. So there is 1.25 lakh minus 2,000, which is 1.23 lakh. Then here we look at cash from investing activity, which is again similar to the last one. We have purchase of equipment, which is about 50,000. So we reduce that. We are paying that from our cash. So the amount of cash we have reduces, this goes down. Sale of machinery. There is some old machinery. We are selling it for scrap. So this is, let's say 10,000, and we are actually getting the cash on our hand. So 50,000 minus 50,000 plus 10,000 is minus 40,000. Right. Then we have financing activities where, let's say, we are borrowing a loan. So there is 30,000. That is what we have borrowed. Right. So then we are getting that amount. That cash is actually coming to us. There is some repayment over here. There is a repayment of the loan, right? And then so we are paying it back. We are losing the money. And then there is dividends. We get dividends. So whenever a company pays us money, basically the company is losing money. So this is also negative. So we have 30,000 in borrowing a loan, and then this is all the repayment, and then we have another 15,000. So then we look at this 1.23. So this we have already done the math. This is the final result, 1.23 lakh. And then we have to do minus 40,000 since the net cash from investing activity is minus 40,000. So this is 1.23 minus 40,000, which is basically 83,000. And then in this 83,000, we add another 50,000. So this is basically 98,000. So we are saying that in this quarter, there has been a net increase in cash. Now the opening cash balance at the start of this quarter was 20,000. And what is the closing cash balance? The closing cash balance is 20,000 plus 98,000, which is 1.18 lakh. So this is typically the logic when we look at a cash flow statement. So if we go to any actual organization, let's just take Lal PathLabs since we've been looking at it for so long. You can see that this cash flow statement is basically more complex. There are many more provisions. We looked at a simple example, but there are factors. They start with the profit for the year. So they are using the indirect method. And then they are basically adding or removing expenses based on whether the cash is an inflow or an outflow. So rental income from investment property. So basically this is a rental income from an investment. It's not a day-to-day operations of the company, right? Dividend income from a subsidiary company. This is again not day-to-day operations. This is a dividend income from a subsidiary company. So it is not part of the operating cash flow. And then they have done gain on, they are basically subtracting the relevant factors over here. We'll not look at each one line by line, but they are subtracting all the relevant factors. They are adding all the relevant factors, and then they are doing some of the same things we looked at: inventories, trade receivables, and so on. And here they have their operating activity. So payments for purchase of property, disposal of property, some other intangible assets, dividends, interest, and so on and so on and so forth. So I think what I would suggest is I'll not be doing this point by point, because the cash flow statement, the points that we are looking here generally differs on the basis of the business. And what we can do, as we were discussing last time, was we can just take a screenshot, give it in ChatGPT and ask it to explain the parameters that we don't understand. So that way it's fairly easy to get an understanding. But what we'll look at is some of the key things that we need to know in the cash flow statement. Yeah. So if we look at a successful company, let's look at us. We are seeing a good, successful, stable company like Britannia, right? So what do we see in Britannia? We see that the first thing is the cash from operating activity every year is positive. Even if you look at quarterly, even if you look at any time period, then basically their cash flow overall, they are getting a lot more cash from the positive cash from the operating activity. So this is very, very important for a business to be sustainable. If the business does not have a positive operating cash flow, then that's a very, very, very big danger sign. Right. On average, cash from investing activity, it is a good. See, it will typically be negative a lot of the time, because as the company is expanding, the company typically ends up making investments. And what you'll find is that the negative values are much higher than the positive values. Cash from financing activity, if they have taken, so in Britannia's case, of course, they are paying a lot of dividends. So they are basically showing it as negative. So in this case, if they did not have any dividends, then this would not be negative, and then they would keep having more and more cash every year. But here they are not retaining so much cash. You can see from here, they have not retained so much cash. But let's say they were not paying the dividend, for example, then all these numbers would directly come down and come over here, and then their net cash flow would continue to be very positive. So the key thing that we have to look at is that the cash from operating activity has to be positive. That is one of the very important signs. And as far as investing is concerned, we just see what is going on in the investing activity. We should understand primarily what is going on. And financing activity, of course, if they keep taking loan, then this number will be positive. But we should see that there is a balance. What is the loan taken? What is the loan repaid? We just get an understanding of those factors over here. So we see here there are some borrowings in which they are getting some money. There is some repayment going on here. So here they have taken some borrowings over here. These are all positive values. And after this, you can see there is a significant amount of negative numbers here. So they are basically repaying these borrowings. So this just kind of gives you a story. This is interest paid. So they're also paying these the interest amounts. And you can see over here, these are like very small numbers. But let's say once they started these borrowings, then you see the repayment of interest amount also went higher. Right. So that sort of gives a very brief overview of the cash flow statement. And my request is we can just study one or two companies, look at the cash flow statements, whatever we don't understand, take a screenshot, give it to ChatGPT, ask it to explain, and then it will be able to explain it to us. So I think this is the basics of the financial statements. The main thing that we have to look at is so let's just summarize what are the key things we are looking at from a financial statement perspective. Right. First thing is sales. For any good company, the sales has to continuously go up over a period of time. If the sales of a company continuously goes up, that's a very positive sign. It means the company is expanding, it is capturing more and more of the market. But at the same time, it is not sufficient for the sales to just continuously go up. The profit also should continuously go up. The company should be more and more profitable, right? And as the company gets more and more profitable, so we see from 2013 when Britannia had 260 crore of profit to say 24 when it had 2,100 crore. As the profit keeps going up over a period of time, we will see, let's see the 10-year, we'll see that the share price steadily keeps going up. That is the key thing we will observe. So we have to find, so this is the key metric, this compounded sales growth and this compounded profit growth, especially this compounded profit growth has to be very high. The higher this compounded profit growth, the faster on average, the faster the share price will go up. Right. In balance sheet, what do we look at in balance sheet? So one of the key things we have to look at is what is the fixed assets and what is the work in progress. So as long as the company has capital work in progress, it means the company is it is basically building new equipment, building new factories, building something or the other, which means that when for a company like Britannia, whenever the capital work in progress is a positive number, it means some new factories are coming up. It's going to manufacture new things. And this means that in the future, its sales will grow up. So that is one of the key things we have to look at. The CWIP has to be higher. The financial assets also have to keep the fixed assets, sorry. The fixed assets have to keep on increasing year on average. So what does that mean? That means that the company has built new factories, it has built new equipment, and therefore it is basically manufacturing a lot of things. So the minute we go to a simple company like this, these numbers being positive tell us that, hey, the company is basically, poised to manufacture a lot of new things. It's continuously manufacturing. it's only if it manufactures and it sells, then its revenue will typically go up. So here the sales is going up, and here we see the fixed assets is also going up, and there is continuous capital work in progress. Okay. Reserves. I think reserves, once reserves goes up, that is also generally a positive sign. The company should not have too much of borrowings. If it has too much of borrowings, then that is we need to be a little cautious as to why it has these borrowing. And generally liabilities, I think we need to typically look at it. So here trade payables is higher. What does it mean? That's a positive thing. It means Britannia is actually buying things, but it's paying for them later. So if it's paying for them later, then basically the company is controlling the trade. So typically a big company, when it buys from small suppliers, it will tell the supplier, hey, you supply it to me from today. So what is Britannia doing? Britannia is telling the suppliers, hey, you pay it to me today, but I will repay you maybe in 3 months or 6 months or whatever. That is the terms that Britannia has from the supplier. But when we go as a buyer and we purchase something from Britannia, we have to pay for it immediately. We don't argue with Britannia saying you give me the biscuits today and then I will pay it to you 3 months later, 6 months later. No. So the company from its customers, it's getting money at the same time, on the same day of the purchase. But to its suppliers, it's basically paying it at a later point of time. So that means the company has more cash for its own use and it's able to it is in control of the cash. It is not like that lemonade stall where we saw that the people are all going to pay the lemonade stall later on, and the lemonade stall has no money to conduct its day-to-day operations. No, in this case, Britannia has all the money it needs to conduct its day-to-day operations. Even here, it even has advance from customers. So maybe some of the large customers who want to buy from the company are also paying some advance, etc. So that's a positive sign for us. Then from cash flow perspective, we will look at, okay, the cash from the operating activity has to be positive. This is very, very important. If the cash from the operating activity is not positive, then it's a huge danger sign. We should not go typically near that business. Cash from investing activity, of course, the company is making investment. We just open and see what is going on in terms of the investment, and we see fixed assets purchased. So it's basically purchasing a lot of fixed assets. Maybe it's buying some equipment, some machinery, and so on. So this just gives us an idea. Okay, so the company is investing more into a lot of these kind of assets, which is very good. And then financing, it's important that the company does not have too much debt. The company should not be, so if the company does not have too much debt, then the interest payment will not be very high. So if you find a company which has a heavy burden and a lot of interest payment, etc., then that is also a warning sign. So here we see Britannia doesn't have too much of interest payment. When we compare the kind of cash it's gaining, here it's gaining 2,500 crore from operating activity, but interest payment is less than 200 crores. So it can easily pay that amount. There's no pressure in terms of interest payment. So this just gives us an idea of the financial health of the company. And these are the generic things we will look at a very, very simplistic high level when we are looking at a business. Okay. So that was it for today.